Hi, folks. Welcome to the Getting Your Edge podcast. My name is Dennis.
And hi, I'm Judy Gratton.
And we're here to help you right-size your home and your life. Welcome, everyone, to the Edge Group Real Estate Team Getting Your Edge, How to Right-Size Your Home and Life podcast. This is episode number 5. Mortgage interest rates yesterday, today, and tomorrow. My name is Dennis Day, and I'm with the Edge Group Real Estate Team. And with us today is our Edge Group Real Estate Team's leader, Judy Gratton. Our special guest is Robert Garrod, home mortgage specialist and VP of growth at Homeseed Loans. Welcome, everyone, and Happy New Year. A video recording of this podcast can be found at the Edge Group Real Estate Team's YouTube channel, YouTube at Judy Gratton Edge Group, if you'd like to see the entire episode live on video. I also want to remind you that if you enjoy this episode, we'd really appreciate it if you would like this podcast, write a review, send a message, share it with others so we can build an audience and spread this information to everyone. And we would certainly enjoy it if you would pop into our website. It's edgegrouprealestateservices.com, and we've got information about buying, selling, downsizing, all the episodes to our podcasts, and a bunch of free things that come with each podcast. So let's get going with our episode discussing mortgage interest rates and the real estate market for 2023. Take it away. Yesterday, today, and tomorrow. Happy New Year, Judy.
Happy New Year, Dennis. Happy New Year, Robert.
Hey, Happy New Year, guys. Thanks for having me.
Yes, this is our friend Robert from Homeseed Loans, Robert Garrod, the Garrod team, coming back again. Thank you.
Yeah, of course. No worries. I'm just here to talk some rates and market. I like it.
Wonderful.
So Robert's our expert today about the mortgage market and interest rates and so forth. He is the VP of growth at Homeseed Loans and a mortgage broker specialist. Robert, welcome. We had kind of a wild 2022. So let's we're going to review 2022 a little bit, maybe a little historical review, and then talk about 2023, what's going to happen or what we think might happen. That sound good?
Yeah, that sounds great.
Okay.
I mean, it's pretty.
And Judy Gratton is also a member of the Edge Group Real Estate Team. So let's kind of get into it. Robert, it was a pretty wild year for 2022. What's the state of mortgage rates at the moment?
Yeah, well, I mean, the 2022, we started out pretty hot, right? I mean, we were still in that heavy market at the beginning of this past year. And everything was going for tens of thousands of dollars, in some cases hundreds of thousands of dollars, in one case in Bellevue $1 million over asking price.
Oh, wow.
And that was a very intense market that we were in. Rates were at their rock bottom. I mean, they were in the threes, low threes to high twos. Everybody and their friends and family were refinancing or looking to buy a house. There was about 30 offers on every property, and things were being sold within 24 hours to a week. Since then, what had been going on, kind of a little historical lesson on why rates were so low is because the short answer is part to COVID. And this market that we're in today actually is the market that we should have been in 2020. Okay. I mean, a lot of people don't know that the reason that rates stayed so low is because the government actually went nuclear and started buying unlimited amounts of mortgage bonds. And so that kept rates low during that time. And once the government started to taper off, which was at the end of last year, then we started seeing the rates rise to where they should have been naturally at this
So
point.
the rates that we saw during COVID, they are artificial. They're not
100%.
They're not going to come back, at least unless we have some other emergency anytime soon. Is that correct?
You never want to say never in this market,
Never,
but it's extremely unlikely we're ever going to see threes again. Or maybe fours. I'd be really happy to see fours again. But threes is going to be tough to get to. Like I said, it was an artificially created market where the government said we're just going to unlimit buy, and now they're selling, right? So now,
when you refer to buying and selling, what are they buying and selling?
mortgage bonds.
Mortgage
So if you're looking at the mortgage bond market, right, as mortgage bonds prices go up, rates actually come down. Okay, so right now, mortgage bonds are down quite a bit. So rates are up, right? What we're seeing right now is a little mix, not just with the rates, but inflation.
Mm-hmm.
Inflation is our number one factor right now, increasing rates.
Mm-hmm.
So we've actually seen a little bit of a decline in rates this past month. And that was due to some inflation easing because of some signs that we've been seeing with the consumer price index being lower than it was the previous year, which was a prediction that we were making here at Homeseed. We figured rates would continue to rise until November and hit their peak and start coming down, which is a little bit why we're seeing some opportunity right now. But this market shift, I want to get back to what we were talking about before, where we had these low rates, and then the government just started selling at the beginning of the year, towards the end of the previous year, in 2021, and so when they started doing that, rates started to rise a little bit, and then we started seeing the price of, and then when Russia went to war with Ukraine, we started seeing the price of gas skyrocket, and then inflation started skyrocketing, and we started seeing inflation numbers rise throughout the entire year over the past year. And then inflation started going out of control, which everybody knows inflation is high right now, right? I mean, there's no one not talking about it today. So that's why rates are continuing to rise, because people are pulling their money out of bonds, right? Because they're worried about inflation. So that means that bonds are down, which brings rates up. So it's a lot of you have to understand the market, but you also have to understand the investor mindset as well, right? For instance, we had a really good inflation reading a couple weeks ago, and then China started opening up their flights. And so what the investors saw was good inflation here in the United States, but they're like, oh, okay, the Chinese are now going to go back to work. They're going to start using their cars more. They're going to start going more transportation. There's going to be more gas being used. Guess what? Gas prices are going to go up. So that's inflationary. So rates actually, instead of going down like we were hoping because of the good inflation reading here in the United States, China made this announcement and rates actually went up a little bit again. So this past week was a little bit of a tough week for rates, but we're still on the downtrend this past month, which is nice. But there's a lot of little quirks that you gotta look out for. So back to the history lesson on this year. But so once rates started to rise, we started seeing buyers starting to hold off on putting in offers, right? They're seeing we saw prices start to come down a little bit on listings. Buyers were starting to hold off a little bit. People were starting to get nervous about higher rates and making higher payments. They thought rates might come back down. And guess what? They just kept going up. up, up, up. I mean, we went from 3 to over 7 in September, Um,
Can you
so
share a graph of what that looks like?
yeah,
Are we seeing that graph?
I'm seeing a presentation with my face on
Okay. There's your face. There's Robert. There's his phone number if you want to give him a call.
Yeah, I'm also a loan advisor for the Garrod Group as well. So the lead loan advisor there, but vice
Here's
president.
A picture of
Robert, do you have a place people can go and check rates on your site?
They can just go to our website and they can review. They can either submit an application or just review rates. I mean, there's also, it's really hard to look at rates. I hate quoting rates to people who just are sitting there because everybody puts a very low rate on their page because it's a perfect scenario, and no one has a perfect scenario. I've never met anybody with a perfect scenario. I mean, you got to have a perfect credit score. You got to live in a perfect market. You got to be purchasing in the perfect market, I should say. You have to be, you have to have X amount of down payment, right? You got to have W-2 employment. You got to have, there's a lot of stuff that factors into the best rate, right?
So rates are not, I mean, they just quoted rates that you hear on advertising and whatever. That's just advertising, really, right? I mean, rate, like you're saying, it's tied to who you are and where you live and what you do. And so that's why it's so important that people check with their lender to see what kind of rate they personally can get. And there's a lot more into that, but I'll let you get back to.
I mean, it depends on anything. It depends on your product that you're going for, right? I mean, we have so many products here that we can use, but the rates vary widely. I mean, like the range is huge. If you're buying even if you are a perfect borrower, let's say you're buying a manufactured home, guess what? The rate's going to be much higher than a normal purchase because of that home. It's nothing to do with you as the borrower, right?
That's more how investors look at it, correctly?
Yeah. So it's risk, right? They think of a manufactured home a little bit more risk. There's less, you're not going to have gain as much equity as a normal house. It's not going to appreciate like a normal home. Same with a condo. You're sharing walls with other people generally on a condo. So there's more risk there for the investor, right? So that's a higher rate for a condo, a higher rate for a townhome. It's just more risk. Anything with more risk. It's slightly higher, but it is higher, right? So it literally depends on almost everything that is going on with your specific situation.
Now,
which rate you want to go with,
when you hear that the feds have raised the rate, that is not necessarily tied to mortgage rates, correct?
Well, why are the feds raising the rate, right? So that's the reason is what we're looking for. We're not looking for exactly like, oh, the rates are being raised. That means mortgage rates are going up. In fact, this entire year, every time the Fed has raised the rate, mortgage rates have actually come down immediately, the same day and following the few days after. The reason being, the Fed is raising the rate to curb inflation. And inflation is the leading cause right now of rates rising. So if the Fed is doing what they're needed to be done, investors are like, okay, they're trying to curb inflation. Let's bring the rate down. Now, how much of a hold does the Fed have on inflation? Now, an added element to this is not only does the Fed have to raise the rate to curb inflation, but they have to say the right things too at these meetings. So like the last one, again, we got a good reading and then they raised the rate. Then they talked to the members afterwards, and one of the members said, yeah, I'm seeing several more rate increases in our future. We just got to get a hold of this inflation. And investors are like, oh, they have no idea. They don't think inflation's taken care of. So, we shouldn't think so either, right? Mm-hmm. So now they're like, okay, well, let's pull our money out, let's not invest in this anymore until we know that we got a hold on this inflation. It's kind of like the stock market, right? I mean, it basically is. So you never fully know, but you can see the numbers at least and make a good guess and be like, okay, I understand that rates should go down. Hopefully the Fed doesn't say something crazy to turn this the other way, but the numbers look good. And we've seen it for this past month and a half now, I believe, where we feel like we've hit that.
Go ahead, Dennis.
The rates are what, around the sixes? Is that what basically?
6.5 to 6.875 or so. I think that's just the national. So the rates that you see where they're saying, hey, the average rate is this, that's just what people are locking at. That doesn't mean like that's the normal price, right? Okay. So if you see a 6.5, generally in this market, you're getting a lot of concessions. You're getting a lot of stuff going on, right? Okay. You're getting things paid for, or people are buying down the rate. So, a normal par rate.
Can you explain that a little bit for people? You mentioned the word lock and buy down. Can you kind of explain what those terms mean?
Yeah. So when you first go to a lender to get your pre-approval, they will look at your par rate generally, or a close buy down for you to see at what level you qualify, right? So how much you qualify for, dependent on your down payment and your situation.
So par means what?
Par means you're paying closing costs and you're not paying anything extra. And you're also not getting anything back for this rate. That is the normal rate for you without making any adjustments. Okay.
So make adjustments by buying down the rate.
You can either buy down the rate in a normal market, you can buy down the rate, and so like, a few extra $1,000 on a bigger home.
So they often refer to that in points, like you buy it down, you pay
discount points.
And those are normally about 1% of the purchase price. Is that correct?
No. That it varies completely. I mean, you can see buy downs for 10 basis points, 5 basis points.
But when you're referring to basis points, are we referring to a percentage of the purchase price?
It's a percent of the loan.
Of the loan.
So it's not even a percent of the purchase price. It's just a percentage of the loan itself. Mm-hmm. So it depends on the rate that you're buying down to, right? So if you want to buy down a full percent, it's probably like a 2 or 3% cost, dependent on the day. But it's how investors are pricing it. Today, with how we're going to talk about later with my prediction and where rates are going to go and where the market is going to go. But today, investors, because they know what I know, there is no credit back to the borrower anymore. So if you are looking at a rate, we're going to see our highest on like 7%, and it's going to be a buy down. There's no credit back anymore because investors know rates are coming down and you're going to refinance this loan. So they want you to pay for it now. And the reason being, when you go to refinance in a normal market next year, you are going to have that credit back. And you could easily, let's say the rates drop to just the 5s and you're in a 6+, 6.5 or 7% rate. You could take a little bit of a higher rate, like 5.5, 5. Let's say the par rate is 5. You take a 5.5 rate, and the company will give you money back to cover your closing costs. So your refinance is technically fully covered, and you're dropping your rate, basically just signing some paperwork to lower your rate. It's really, I don't like to say free, but it's basically no money out of pocket, and you don't have to pay anything extra besides just getting your.
And most people don't understand that in addition to their down payment, there are what's referred to as closing costs. And what are those?
Well, your closing costs, there's going to be a lender fee. Generally, it's not very big at all. I mean, well, for us, I think it's like $1,500, which is not much on a normal, $1 million loan or $500,000 loan. It's very low. And then at the discount point you pick, whatever that is, if you do pick one, then there is your normal closing costs for your appraisal, your third-party fees. It's just basically whatever you choose. There's an insurance company that you have to pick. You pick your insurance, you pick your The seller actually picks the title company, so you're stuck with whatever cost the seller picks there. Mm-hmm. But generally, it comes out to, I'd say, $8,000 to $12,000 on a normal size loan, mid-size loan like a 500K. Mm-hmm. But if it's lower, then those closing costs will come down quite a bit. Bigger loans is nice because they, yeah, and the bigger loans are actually nice because the closing costs are not as bad because they're still around that $8,000 to $12,000 range generally, unless you're doing bigger discount points, because that adds up when you have a bigger loan. But for the most part, today you can get that covered, but most people don't understand that, right? It's a little bit. It's an opportunity in today's market.
So, Robert, look at the graph here is the 30-year historical. Actually, that's 50 years. I don't know why it says 30. It should say 50, or the 30-year mortgage rates for 50 years. There we go, to 22. And see, here's the start of 22, and now we're at 2023 here.
Yeah.
Even though we're in the sixes, we're still below the 50-year average.
Yeah. Yeah, and we're coming back down, which is nice.
So that unicorn rate, and we can call it that because it was 2-3 years, that it's just not going to be there. It's not really a normal sort of part of the mortgage.
Yep. And what's kind of not great about what's happening right now is a lot of the government and most people, they're looking at numbers, and you're seeing people talking about housing crashes. And the reason that they're talking about this is because they're comparing numbers from the previous years. And you're comparing numbers from the last 2 years, like foreclosures are way up. That's my favorite one. It's like we didn't even have any foreclosures, during COVID. Of course foreclosures are going to go up from zero. What? Right. Why wouldn't they? You're going to see that. You're going to see these 1,000% increases in this, or whatever percentage increases from last year, or decreases even from a completely abnormal market, right? So we're just stabilizing right now. We're in a crazy market. This whole year has been a roller coaster in the fact that we're still trying to find our ground, right? We're trying to find our foot, but there's always a window of opportunity, and what's that opportunity is what we got to figure out.
And what I think, people right now are really afraid to buy, they're afraid to sell because of the interest rates. And like you said, they're saying they're waiting for them to fall or the housing market to crash, which it's not going to do because mortgages are much safer than they used to be. But I like the terminology, the market you sell in is the market you buy in. I mean, if your home has lost some value, chances are pretty good the home you're going to buy has also lost some value. So you're still looking at making the same sort of, what's the word I want? It's all going to pencil out in the end. Yeah. Now, that's not always true. If you were moving to another part of the country and they had a really good economic situation going on and the area you were moving from had a really bad economic situation, that could make a difference. But right now, all across the country, we're kind of looking at this adjustment in the market, right?
Yeah. No, I mean, a lot of people are waiting for rates to come down. But the only thing negative about this market, and honestly, I've been in this industry for 10 years, and I've never said this before. I do think that this is the best time for people to buy. And the reason is rates is the only negative thing for a buyer in this market.
Absolutely.
You can
actually,
it's the only negative thing. I mean, it sucks. It's a high payment. It's a higher payment than it was 6 months ago, 8 months ago. But everything else about this market is such a positive. I mean, if you're looking at just numbers alone, I said earlier closing costs are $8,000 to $12,000. That is covered. I have a client closing in 20 days from now, and closing costs completely covered, and then a rate buy down covered on top of that.
By whom? Who's covering these?
The seller. The seller is covering them. And the reason is there aren't 30 offers on every house anymore. Everybody is waiting for rates to come down. And so that is why prices are coming down, because there's less buyers, less demand, right? And so since there's less demand, there's less offers going out on homes. And so sellers are willing to negotiate and come up with a good strategy to get you into your home. So for instance, this house was for sale at $800,000. Okay. We offered $770 with no credit. They countered at $785. And then we countered and we actually increased the price to $800. And we said, but we want a credit back for $15.
Mm-hmm.
And they agreed. And so obviously they agreed because it's the net, right? And so the buyer, they would have, if you drop the price from the home for $15,000, maybe it saves them like, I think it was like $75 a month. But guess what? That $75 a month was your principal balance, right? That's going to principal. So that's coming back to your pocket. Okay. If you put that money towards interest instead of the principal, now you're putting money back into your pocket instead, because you're going to lower that rate down by quite a bit. We actually lowered it down by like $250 a month, that payment, by buying the rate down with the extra money. And guess what? That money, that $250 a month that we're saving, was going to the bank, not back to their pocket, right? So yeah, that $75 extra a month that for $15,000 or whatever it was. I'm just guessing, by the way. Wasn't that, so I don't know exactly, but that money was going to come back to him anyways, right? So that is back added on, but we take $250 off of interest, which is the thing that you really want to save on, right? At the end of the day, because yes, he's going to pay a little bit more than he was at the lower purchase price for the principal, but it's really just money coming back to them because it's going into the equity of their home. What you really want to do is get that interest down so that you're not paying the bank, you're paying yourself.
But the seller also wins on this as well.
Yeah, because they get the same net. Exactly. And guess what? We got the appraisal back yesterday or Friday, and there was more equity than the $800,000.
Wow.
So
and that's the thing, you need to be careful with those, that you always have to take into consideration when you're financing what the appraisal will be, because the loan can only be the percentage you negotiated of the appraised value or the sales price, whichever is less.
Correct. 100%. But what's great about this market is everything's going below value. I mean, 90% of our I mean, that's not exact, but what I'm seeing, about 90%, we're seeing about a ton of appraisals come in high. And that's because the market is coming lower, right? People are negotiating and trying to get lower purchase prices and all that. So their appraisals are coming in higher.
Very
which
good.
is great. You're starting with more equity. And guess what? When rates start coming back down, home prices are going to come back up because we're going to see buyers coming back. We're already seeing it. We're already seeing more applications come in. We're not seeing more people purchase right now because it's holiday season, because that's just how it is every year.
Right.
I know people are like, oh, I think there was a quote the other day from one of our Fed members that said, oh, I just don't understand why people aren't buying because rates just went down this last month. We're not seeing many more people. And it's like, well, it's December. Who wants to move in December?
Right.
With Christmas coming up, if it's not the right time, people aren't like
recently. Yeah.
But we are seeing more applications coming in, more interest coming in already. And so the opportunity is you're going to have all this stuff is up for negotiation now. I mean, are you seeing that as an agent?
We're beginning to see that, yes. And we're hearing, what we're trying to put out there for people to understand, and we use these pithy little sayings, is marry the home and date the rate. I'm sure you've heard that one. So, get your home now while you can negotiate all those other things to get the best price on your home and the best terms. And then when the rate goes down, you refinance. And so now you have the best of both worlds, right?
I mean, I think few months ago, I was kind of saying that same thing, and also saying if rates never come down, then you got the rate at the lowest point in the market from here on out, right? But the fact of the matter is that after looking at the numbers and reviewing this market for the past 6 months, is we know rates are going to come down. I know it. Like, can you imagine looking at a stock market and being like, I know this is going to happen? That's crazy. So that's what the opportunity is in this market. Like, you have to look at it, at the numbers. You have to look at the market itself, study it. And the reason that I know rates are going to come down is because the CPI index every year, which is our number one factor, it's also a lagging factor of a lagging indicator of inflation.
And can you explain what that is, a CPI?
A consumer price index. So it's basically what the government looks at to determine where our economy is generally. And so it's looking at the increases from year over year and month over month. Okay. Now, if you looked at the last year compared to this year, we were getting readings of like 0.6 this year, of consistent 0.6, 0.7, 0.8, high readings generally. And then you add up all these readings, and then that's your percentage of inflation that's increased for the year. Okay. I believe a normal year is 2 or below, 2% or below. Okay. This year it was predicted to be over 6, and I think it's dropping to, I don't quote me on that actually, but it was lower than what they thought it was going to end up being. If you're looking at last year's CPI readings, you're going to see low readings all the way up until November, okay? Or October, I should say. So October, there was a high reading in October of last year. And then if you're looking at our readings this year and you're like, oh, they were starting to come down a little bit, this is going to be way lower than last year's October, right? Okay. And it was. Did you remember that day in November where rates dropped? It was a 200 basis point day, which is I've never seen before. It dropped. That was the day they announced the October reading, but in November, because it's a month difference when they announced the readings. Okay. Now we're competing against high readings from last year. So we're going to get, and we've been increasing these rates. The Fed has been doing that. We're already seeing things slowing down. I mean, you're living it, right, Judy? I'm living it. We're seeing everything slow down. We know those readings are going to come down. As we see those come down, rates are going to come down as well. Okay.
They're going to come down to 3%.
They're not going to come down to 3%. Yeah. I mean, there are people predicting it. I've seen it. In the past month, someone predicted a 3% rate for this year. I think we will get to the 5s I was hoping by February, but I'm thinking March or April. Definitely springtime. And I'd love to get into the 4s by the end of this year, because I think that unfortunately we are going to go into a recession. We are seeing those numbers. That's a longer conversation, but we are definitely seeing, if we're not already in it, that we are heading for recession. And historically, every recession that we've ever had, rates have gone down.
So they're not going to come to 3%.
No.
And people have to get past that.
I don't think anyone is expecting it to get back down to 3.
Yeah.
I think people just don't want to see 7, 6. If it dips to the 5s, we're going to see a frenzy, I think, like we did last year. Similar.
Historically, 5 is really pretty good interest rate.
Yeah.
If you look at the 50.
I mean, anything you can get below 8, honestly, because of generally return on investment. If you're going to put that money into something else, you can get 8% year over year. If you want to get into a home at less than 8%, that's a really good point for investors, because they like to keep their money in homes and then invest and pocket the difference.
We've got a situation where a lot of homeowners have refinanced or even bought at low rates, like around 3%, and they don't want to move.
Yeah.
Because they don't want to give up that rate.
Yeah.
How can somebody who says maybe wants to do a move up or go to a home that is maybe in a more expensive area, so they're moving sideways in cost, but maybe downsizing a little bit, what can they do to minimize that shock of going from a 3% low interest rate to a little bit higher?
And then there's a couple things that you can do. You can look at 2-1 buy down, or possibly doing an ARM, an adjustable rate mortgage.
Can you explain how those work and why those are good things?
So, like I said, we know rates are coming down. A lot of people are erring on the side of caution right now, though. So I have talked to people about these strategies. They're a little complex, some of them, but ARMs, I mean, if you're looking at an adjustable rate mortgage, you can have one that is locked for 5 years, 7 years, 6 months, whatever that be. And then at that point in time, once that's done, the rate will go down to what the market is at that time or up. So it depends on where you think the market is going to go. And so we think that the market, and generally on an ARM, your rate is much lower than a fixed rate because that's the beauty of the ARM. That's the reason why people go with it. But you have to understand the market and know where it's going before you can pick a situation, a product like this. The 2-1 buy down is my favorite thing right now because the catch of the 2-1 buy down is it has to be paid by the seller.
Okay.
And the seller in this market is giving that up. Okay. Now there has to be a certain amount. So when you're going to make your offer, you have to talk to your lender and figure out the exact amount that needs to be covered by the seller before making your offer. And then once that's done on a 2-1 buy down or a 3-2-1 buy down, which we also have access to, is let's say your rate is 7%. On a 2-1 buy down, your first year, your rate would be 5%. On your second year, your rate would be 6%. And then from then on forward, you're back to that 7%. And it's basically, it is a dollar for dollar buy down. Okay. And most people are like, why is that helping me at all? How does that help me? Because, well, one, the seller's paying for it. And two, if you know rates are going to come down, if you refinance this in 6 months or a year or before that time frame is up that you're going to go back to your normal rate, you get the refund of whatever is not been made or been used in a reduction to your principal. So you're basically going to get
held in escrow, correct?
So essentially it's held in escrow. All that money from the sellers is held in escrow, and then it's just sent out with your payments every month as the interest, right? So it's basically like the seller is just paying your interest every month. And then, but if you refinance before those 2 years are up on a 2-1 or before the 3 years are up on a 3-2-1, you get whatever is left over back in a reduction of your principal. So what we're doing now is we're getting people in these buy downs, and then we're like, okay, 6 months from now, we're going to go look at the rate and we're going to try and get you a free refinance, basically. You can't say free, but the seller is going to pay for your refinance too, essentially, which is unheard of, right? Like it's hard to plan for something like this unless you really know the rates are going to come down.
So you're anticipating that in 2023, we're going to see rates come down, and we would hope maybe for 4% would be like really great, but 5s are still spectacular rates, correct? And I think what I'm hearing is it really is important that you have a lender like Robert who knows what's going on in the market and can get you the best rate and terms to really protect your interests. And then if you're a seller, just remember that you are in a market where what you're going to be able to take advantage of the same things when you go to buy that you're doing for your buyer when you're selling, correct?
Yeah, and also, when you're selling too, you're going to be able to negotiate with your buyers, right?
Correct.
Like if you had a lender on the selling side of things, they would tell you offer credits, don't lower your purchase price. Offer credits, keep the price high, because in the end, it's going to benefit your buyer way more to pay their interest than it is to lower the price of the house. You're going to look at that monthly payment that you have for 30 years, right? You just want that payment to be lower. It's a 30-year payment, no matter what it is. If you get that payment lower, that's when you're saving money. And if it's higher on your principal, that's just money coming back to you. It's lower. You want that interest payment as low as possible, because everything else when you sell your home, or if you refinance, or if you want to get a home equity line of credit, whatever, you can get that money out. And by the way, when the Fed does say to raise the rate, that they are raising their rates, that is your HELOCs, that is your credit cards, and that is your construction loans. So anything that is kind of a little more out of the box than a mortgage, those are going up as the Fed raises rates. Okay. But mortgages will come down because they're on a different system.
Fantastic.
That super hot market that homeowners would say, I can't move because I can't find a home to move to.
There's always a thing to complain about in every market, right? Like, honestly, that's you only hear the negative. So 8 months ago, when rates were in the 2s or 3s a year ago, that was what we heard, right? I don't know where to go because everybody's buying houses and the housing prices are so high and they're going up. So yeah, rates are low and there's a lot of buyers in the market, and so prices are going to go up. Guess what? Rates are high, prices are coming down, and you can buy the house that you want, whatever you want, honestly. And guess what? You can negotiate. You can negotiate anything. You can get your inspection done. You can take your time with the house that you pick. You can get your costs covered. You can get your rate bought down. You can get your mortgage insurance paid off up front. You can do that, so you have nothing there. Which means that you still have mortgage insurance, but it's paid for by the seller. It's like literally everything about the home buying process is in the buyer's court right now, but the interest rate. And guess what? We're focused on the interest rate. Buyers are only focused on the interest rate. And it's like, well, look at anything else in the buying process, and you're going to understand the opportunity right now is not the interest rate. The opportunity right now is getting you the home with just your down payment and not a dollar more. And then guess what? Rates are going to come down next year, and you can refinance. And if you're with a good lender, they'll have a plan for you to refinance when you're getting into contract to buy your house and getting you to refinance into that lower rate 6 months, a year from now, 2 years from now. It's really like a no-brainer if you can afford it.
Right.
Is it a good time you're a homeowner and want to move? Is it a good time to buy first, then sell your home?
That's a good question. I would think that buying right now, if you can afford it, honestly, because you would have to do a bridge loan or qualify with 2 mortgages to buy first. A lot of people can't do that. And, that's a lot, especially with rates being so high. I think it's a great time to sell at the same time as you buy, though, because then you can actually negotiate with your buyers on good move-in dates. You can negotiate with your sellers your move-in dates. Everybody works together right now. It's a really nice, it's more of a team thing than it was before, where it was like listing agents were basically just had their pick of the litter and didn't give us the time of day every once in a while, But now it's like, okay, what do you want? So you can actually say, hey, I want to buy this house. And you can put an offer in on a house and say, hey, it's contingent on selling my home, and the seller will accept that today, which that wasn't going to happen a year ago.
Should somebody whether they're a homeowner or a buyer that's looking for a lender, what think they should be looking at?
A lot of people just go to their bank and credit unions, and those are the places that I would highly avoid. Highly recommend not going to. They definitely have decent rates there for sure, but you're going to someone who's not licensed fully. You're going to someone who is sitting there waiting for business and not understanding the market fully. Someone who doesn't just do mortgage loans and does banking or car loan, anything else. It's a bank, right? Or a credit union. So for the most part, I would recommend going to someone with great reviews, someone who's licensed. You can look them up online, look up their licensing history, NMLS Consumer Access website. You can just Google that, and it's the first thing that pops up. Reviews and referrals are our number one thing. You just want to make sure that somebody is going to take care of you from the beginning and give you your max eligibility, but be able to guide you through the whole process. It's hard to say that and talk to a first-time home buyer or someone, because they don't understand. They're like, okay, I'm just going to go to my bank and get a low rate. Well, it's like, okay, well, if you go to a bank and they give you a lower rate, they're probably just going to say, okay, here's your rate, and then we're going to lock you in. If you go to the right lender, they're going to go, okay, here are different rates for you. Here's what the benefits for each rate and the benefits for you. You decide which one you want to pick. And then they're going to say, okay, I understand the market is going this way and that way. I predict the rates are going to fluctuate up and down here. I think this day is going to be the best day to lock your rate. Because when you go lock your rate, that could be a plus or minus of tens of thousands of dollars. Or I had somebody wait one day to lock their rate, and it saved them over $6,000 because of me saying, hey, I think the rate, we're going to get a good number tomorrow, and rates are going to wait. So same with you on the when I was talking about earlier on the CPI index, I had all my borrowers waiting until the CPI index was released, and we had that huge drop off, and people were very happy, right? So maybe I don't have the lowest rates. Only one company in the entire country has the lowest rates, but I will guide you to a lower rate than a company that has lower rates. That's how I look at it. Yeah, I mean, it's. Do you have that slide up? I think that's pretty much my phone number, 206-963-4562. That's my phone number. You can email me at robert@homeseedloans.com. My website is www.homeseedloans.com/Robert. Pretty easy.
Have a podcast.
We do.
This Zoom meeting is going to go directly to our podcast.
Yes.
And so people could listen to it. If they're interested in our podcast, they could go wherever they find their podcasts at, Apple or Google or whatever, and go to Getting Your Edge podcast. And we drop episodes every other Monday.
Correct. And we do have a freebie. We have a freebie from Robert that will be up on our site, on our website. Correct?
Correct. Robert, can you share that?
So I sent you guys.
Oh, maybe
I sent you an image. I'm sorry.
Okay.
Of the Sorry, I sent you an image of the market. I didn't think of I thought you were talking about something else. Okay. I thought you were talking about my section. So that's basically what we were talking about a moment ago with where we are today in that market. It's a good image to show you what the opportunity is.
And I do want to make that point that this is a snapshot of the market today. And that changes. The value of your home, the loan that you can get, the interest, it's always in flux. It changes daily.
Even
home value changes.
Even the value of your lender changes in the market. I mean, my value today is understanding the market, like we just talked about, and figuring out these complex or different strategies to get people into lower rates with plans to refinance in the future. Whereas 10 months ago, my value was closing very quickly and understanding that we are going to close when an offer is accepted and making sure that we are guaranteeing closes and all that stuff. So it literally, the value of agents, the value of everyone in our industry changes as the market changes and shifts. So you need someone to know the market of every day so that you can win. Otherwise, if you have someone who's doing the same thing that they were doing 10 months ago, you're gonna have a tough time.
Correct. And we will have that handout, that freebie for you on our website, edgegrouprealestateservices.com. So that'll be available for you to pick up there. And as we said, this is the current market as of today. And today is New Year's Day, 2023. And I want to thank you, Robert and Dennis, for taking your time on New Year's Day to go over this with people.
Thank you so much for having me.
And wish everybody a happy New Year's.
23 is a year in the real estate market.
Yeah, and it's supposed to be a banner year is what everyone's predicting. So I'm really excited for it. And you guys have a happy New Year. Thank you so much.
Thank you, Robert. Thank you so much. Dennis, thank you.
Okay. Happy New Year, everyone. Talk soon.
There you have it. Episode 5 is in the books. Just a quick review that interest rates are coming down. It's not a totally insane market. There's a more collaboration between buyers and sellers, and everybody's looking for a fantastic 2023. Please like us, comment on this podcast. A review would be fantastic. And in the episode notes, we will make sure that Robert Garrod's information is there if you want to contact him. Thanks for listening. See you next time. Bye. That's it, folks. Thanks for listening. And stay tuned for future episodes wherever you get your podcasts. Thanks. Goodbye.